What's up, everyone? It's Eric with Option Edge, and today we're going to go over call credit spreads, what they are, what they mean, and I'm trying to help with the confusion behind them because I get a lot of questions. What's a call credit spread? What's a bull put spread? So today we're going to go deep into call credit spreads. So let me flip over to PowerPoint. So call credit spreads, also known as bear call spreads. Okay, the reason why it's called a bear call spread is because you're taking a bearish position. We're going to use Lucid Motors as an example today. So if you sell a call credit spread and the stock goes up, you will lose money. So if you sell a call credit spread and if the stock goes down or doesn't move at all, you will receive credit and make money. Okay, that's the basics of that. So just a little overview, a call credit spread is a type of vertical spread, and we've been talking about vertical spreads in a couple other movie videos, and I'll link those two videos up top. So you have different types of vertical spreads. You have credit spreads and you have debit spreads. So debits, anytime you hear debit spread, think you're net long, and then anytime you hear credit, you're net short. So you have put credit spreads, put debit spreads, and then you have call credit spreads and call debit spreads. So a call debit spread is a position where you're long, and a call credit spread, which is what we're talking about today, is a position where you are short. So let's just go over let me just explain what a vertical spread is, just to give us a little bit of a background. Vertical spread involves a simultaneous buying and selling of options of the same type. So either puts or calls. In our example today, we're using calls, and they have the same expiry, but different strike prices. The term vertical comes from the position of the strike prices. You have one high, one low. And in our case, we're selling and buying a call. Okay. So let's go back. Let's go over to Robinhood just to show an example of this. So right now I already have it selected, a call credit spread. So right now the share price is at almost $24, the stock price. So the underlying is right around here. We're going out of the money to 27 and we're going to sell. So let me delete this. We're going to sell a call, the $27 call. And then we're going to go even further out of the money and buy a $30 call. So we sold the 27, bought the 30. So if you notice if the stock price is at 24, that makes this $27 call closer to the money and it has more value. It is 73 versus 44. I just deleted those accidentally. So now that I showed you that example, let me reselect those. Selling the call at 27, and then we're buying it. Okay, so you can see that 73 has more value than 74, even though it's negative. It's negative because we're short. Okay, so we explained that. So now I'm just going to explain here what we just did on Robinhood. We're starting with a call that's closer to the money. So in this case, the $27 call is closer to the money than the $30 call, and we start with we sell the closer to the money call. And notice that has more value, okay? We buy the more out of the money call, and that actually has less value. So that means you're net short because you're selling a more valuable option, and then behind it, you're buying a less valuable option. Pricing. So the long call, so in our case, the 30 strike, which we bought, which we're long at, which is our long call, it's going to subtract its value from the short call. So if we look, our long call is at the 30 strike. Notice it's 44 cents. And then we have the 73 cent short call. We subtract the values and we get the total value of the credit spread is 29 cents. Okay. And in this case, we're adding the value because we're starting with a short position. I think that's understood. So overall, this option strategy is a net credit because we're net short as opposed to a debit. Debit means long, credit means short. So just to reiterate how to derive the call credit spread value, we're going to take the short call, subtract the long call value, or in this case, since the short call is negative, you'd add the long call value. And either way, you could take the absolute value of the short call, absolute value of the long call, subtract them, and then since you're short, you just throw a negative sign on it. That's probably an easier way to think about it. So here's our Robinhood example. We're selling the 73 the $27 call at 73 cents, and we're buying $30 calls at 44 cents. Net credit of that is 29 cents. Okay. And once again, 29 cents, selling that, buying that, they subtract 29 cents. That's how you derive that. We'll go one step further and talk about net delta. So the net delta of this option strategy, we can take a peek. We have the 27 delta, which is 28.27. And then we have the 30 delta, which is 17.20. Okay. So we take those, subtract them, and we get 11. You can multiply that by 100 because it's just that's one per one contract, but we're trading 100 contracts. So the net delta is short 11. It's like being short 11 shares of Lucid stock. Okay. Max profit. How do you calculate max profit? It's the net premium received. So the most we can make on this is 29 cents. Unlike a debit spread or a call debit spread or just a straight up call where the debit you pay you can make more than that. In this case, we can only make the total credit. That's the max profit we can make. Okay, and then this little profit loss diagram gives us a little idea. So if the stock, we're bearish here, if the stock goes down to $20, or $21, we still make that 29 cents. Okay, and then we're going to calculate other things. So our max loss. So this is how you calculate max loss with call credit spreads. You're going to take the spread between the strike prices and then subtract the net premium received. So we have a $27 strike and a $30 strike. The spread between those is 3. Subtract that. 30 minus 27 is 3. Then we're going to take that and subtract the net premium received, which was 29 cents. Okay. So our max loss is going to be $2.71. Let's go back to Robinhood. Let's see if that is true. We come here. If you look up, here's the expected profit and loss. Watch as that changes. You see right here at the $30 strike, which is actually coincidentally the strike we're long. If the stock goes above our $30 strike, we will hit max loss of $271. So that's max loss. Break-even point. So this is the point at which you start to lose money. So break-even point is the short put strike price. So our short put in this case is 27 plus the net premium received. Okay, we received 29 cents. So let's look at that. So it should be 27.29 should be the break-even price. What do you know? 27. If you look at the profit loss, check it out. It should be 0 when we approach 27.29. There you go, 27.29. And that's the break-even point. And yeah, that's it. That's what a call credit spread is. Hope that makes sense. It's also a bear call spread. So you can use these type of strategies. You can do a lot of different things with these type of strategies. For example, right now we're in a type of environment where growth stocks they're not growing. And you could, or over the last 6 months, if you continuously sold call credit spreads, you can make a lot of money because the stock prices of these things aren't really going up. They're not really going down. So that's one of the major benefits of call credit spreads. But that's that. That's them in a nutshell. So I hope this was informative and you learned a lot. Anyway, that's it. Like and subscribe, and peace out.